$600 billion. That is how big Lehman Brothers was when it collapsed. Not a small company, not a weak company, not some random business nobody had heard of. Lehman was one of the biggest names on Wall Street. And then it failed. In September 2008, Lehman Brothers filed for bankruptcy in what became the largest bankruptcy filing in U.S. history. A firm that looked powerful, respected, and deeply connected to the financial system suddenly broke apart. And when it did, the panic did not stay inside Lehman. It spread. Because Lehman's collapse was not just about one investment bank going under. It was about what happens when a financial system is built on too much debt, too much confidence, and too much hidden fragility. The scary part is this: Lehman did not look weak from the outside until it was too late. It looked big. It looked established. It looked like it belonged at the center of the system. But inside, the structure was becoming more fragile by the day. This is the story of how a 158-year-old Wall Street giant collapsed under the weight of leverage, bad bets, and vanishing trust. And why the failure of Lehman Brothers became one of the defining moments of the 2008 financial crisis. Lehman Brothers was not some tiny fringe player. It was one of the major investment banks in the United States. For decades, it had built a reputation as a serious Wall Street institution. It financed deals. It traded securities. It participated in the machinery of modern finance. To regular people, firms like Lehman often seemed distant and abstract. You did not walk into a Lehman branch like a neighborhood bank. But in the financial world, Lehman was deeply connected. That mattered. Because when a company like that gets into trouble, the damage does not stay local. It touches lenders. It touches trading partners. It touches investors. It touches confidence across the entire market. And by the mid-2000s, Lehman was making enormous bets in an environment that rewarded risk. The housing market had been booming. Mortgage lending had exploded. Wall Street turned those mortgages into securities. Those securities were bought, sold, packaged, rated, leveraged, and spread throughout the system. As long as housing kept rising and money kept flowing, the machine looked brilliant. Profits looked strong. Balance sheets looked impressive. Big firms looked smart. But the system depended on one dangerous assumption: that housing prices would stay strong and that the risk inside all these mortgage-related assets was manageable. That assumption was about to break. Lehman loaded itself with exposure to real estate and mortgage-related assets. That was one of the key problems. When the housing boom was running hot, that exposure looked like opportunity. It looked like growth. It looked like confidence. But when housing started turning, the same exposure became poison. Lehman had tied itself too closely to assets that were losing value. And it was not just holding risk. It was holding a lot of risk while relying heavily on leverage. Leverage is one of those words that sounds technical, but the idea is simple. It means using borrowed money to increase the size of your bets. If things go well, leverage makes profits bigger. If things go badly, leverage makes losses hit harder and faster. That is what made Lehman so dangerous. It was not just exposed. It was exposed at scale. This is where big financial collapses often become deceptive. From a distance, leverage can make a company look more successful than it really is. Returns can look stronger. Growth can look faster. Executives can look smarter. But underneath that success is a problem. The whole structure becomes less forgiving. Small declines can become major damage. Doubt can become panic. And once confidence breaks, leverage stops being a tool and starts becoming a trap. That is what Lehman was walking into. By 2007 and 2008, the housing market was weakening. Mortgage-related assets were under pressure. The market was starting to understand that the system had far more bad risk inside it than many wanted to admit. and firms that were heavily exposed began looking vulnerable. Lehman was one of them. One reason collapses like this become so shocking is that large institutions can still look stable while the foundation is cracking. That is important, because most people do not see internal weakness directly. They see headlines. They see branding. They see age, size, reputation, and confidence. Lehman had all of that. It had history. It had prestige. It had scale. That created psychological protection. People assume a giant firm must know what it is doing. They assume it has smart people in charge. They assume the danger would be visible before collapse. But that is not always how failure works. Sometimes the outside image lasts longer than the inside strength. Sometimes the brand survives right up until the structure gives way. That is one reason financial disasters become so dangerous. They are often hidden inside complexity, confidence, and delay. By the time the public fully understands the weakness, the options are already shrinking. Lehman tried to survive. It tried to stabilize confidence. It tried to find solutions. But markets were becoming more fearful. And fear in finance has a very specific effect. It changes behavior fast. Lenders pull back. Counterparties hesitate. Investors question valuations. Liquidity becomes harder to get. A firm can survive bad headlines for a while. What it cannot survive is the loss of trust from the people and institutions it depends on every day. At the core of Lehman's collapse was trust. Modern finance runs on trust far more than many people realize. Not blind trust. Operational trust. The trust that loans will be repaid. The trust that collateral is worth what people say it is worth. The trust that counterparties are stable enough to finish the deals they start. The trust that if you extend funding today, the institution will still be standing tomorrow. Once that trust weakens, the system gets dangerous. And once trust disappears, speed becomes the problem. That is what happened in 2008. Lehman faced growing skepticism about the value of its assets and the strength of its position. The market became less willing to believe reassuring words. Investors became more nervous. Potential partners became more cautious. And when confidence drains out of a financial institution, it does not usually happen in a calm, orderly way. It becomes a race to reduce exposure, a race to preserve cash, a race to avoid being the last one still standing nearby when the structure falls. That dynamic can destroy institutions very quickly, because large financial firms do not only need assets, they need funding, they need counterparties, they need continuous confidence. Without that, the machine starts choking. And once people began doubting Lehman at a serious level, its room to survive narrowed fast. Then came the breaking point. On September 15, 2008, Lehman Brothers filed for bankruptcy. That single event sent shockwaves across global markets. The symbolism was enormous. A 158-year-old Wall Street giant was gone. One of the most important firms in modern finance had fallen apart in public view. The collapse was not just a business story, it was a system story. Because now everyone had to ask the same terrifying question: if Lehman can fail, who is safe? That question matters more than people think. Markets are not driven by math alone. They are driven by confidence in who survives, who pays, who honors obligations, and who still has access to money tomorrow. Lehman's failure made those assumptions feel unstable. And once that happened, panic spread wider. Credit markets froze. Fear surged. Investors and institutions became even more defensive. The crisis did not begin with Lehman alone, but Lehman became one of the most explosive turning points. Its collapse became a signal that the danger was real, the fragility was deep, and the financial system was under far more pressure than many had wanted to admit. So why did Lehman's collapse hit so hard? Because size alone was not the story. Connection was the story. Lehman was woven into the financial system. That meant its failure carried consequences beyond shareholders and employees. It affected counterparties. It affected funding markets. It affected confidence in other firms. It affected how risk was priced everywhere else. And when fear spreads through finance, it becomes contagious. People stop asking, "Is this one company weak?" They start asking, "What else is weak?" That shift is devastating, because it turns a single collapse into a broader crisis of trust. This is one of the biggest lessons from 2008. A system can look advanced, sophisticated, and intelligent while still being dangerously fragile. In fact, complexity can sometimes hide fragility instead of reducing it. The more layers there are, the easier it becomes for risk to spread without being clearly understood. That is part of what made the crisis so severe. There were too many connections, too much leverage, too much bad housing exposure, and too much dependence on confidence staying alive. Once that confidence broke, the losses were not just financial. They were psychological. The market's sense of safety collapsed too. This is where the Lehman story becomes even more important, because the collapse was not just mechanical. It was psychological. The financial world had spent years believing in the strength of the system. Big firms looked untouchable. Housing looked durable. Structured finance looked sophisticated. Risk looked dispersed. But those beliefs created comfort. And comfort can create blindness. That is a recurring pattern in major collapses. Success creates confidence. Confidence creates larger bets. Larger bets create hidden fragility. Then one break reveals that the strength was overstated the whole time. Lehman became one of the clearest examples of this pattern. It was old. It was prestigious. It was embedded in the center of finance. That made people feel safer than they should have felt. And when institutions give off that kind of confidence, markets often delay hard questions. They assume the structure must be stronger than it really is, until reality interrupts the story. That is why collapses like Lehman are so shocking, not because weakness appears out of nowhere, but because it was easier to ignore than people wanted to admit. So what is the real lesson of Lehman Brothers? It is not just that leverage is dangerous. It is not just that housing bubbles can burst. It is not just that financial firms can fail. The deeper lesson is this: a company can look powerful while becoming fragile. A system can look sophisticated while becoming unstable. And confidence can hold everything together right up until the moment it no longer does. That is why external success should never be confused with internal strength. Big names fail. Prestige fails. Old institutions fail. And when growth is built on too much borrowed money and too much weak underlying value, the collapse can come fast. Lehman was not a random accident. It was a warning about leverage, a warning about concentration of risk, a warning about what happens when the system depends too heavily on faith, short-term funding, and rising asset prices. And when that warning finally turned into collapse, the entire world felt it. Lehman Brothers did not just lose money, it lost trust. And once trust disappeared, the size of the firm was no longer enough to save it. That is what made the collapse so terrifying. Because if a giant can fall that fast, then the whole system starts to look different. That is why Lehman still matters. Not just as a bankruptcy, not just as a Wall Street failure, but as one of the clearest examples of how fragility can hide inside power. If you want more breakdowns like this on corporate fraud, financial collapse, and business failure, subscribe and watch the next video. Because some of the biggest companies in history did not just fail. They looked strong right until the end.